Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we finished up our discussion on GDP with a look at the different components that make up the number and why these are important to traders. In today's lesson we're going to start our discussion on some other economic numbers which are more timely than GDP and help traders get an earlier feel for what's going on in the economy. So let's get started.
As there are so many things which can be measured in an economy, there are tons of economic releases every month, with new numbers coming out on almost a daily basis. With all this data, it's easy to get overwhelmed when looking at the economic calendar and trying to determine what's important to us as traders. While the importance of different economic indicators to the market changes depending on current economic conditions, there are approximately 10 major economic indicators that have always and will always be important to the market. Most of the other data that's reported throughout the month is similar to one of these 10 indicators, so once we have an understanding of the main numbers, everything else will make a lot more sense. Before getting started here, it's important to understand that economic releases are designed to try and give a picture of either what has already happened in an economy based on past numbers, which is referred to as a lagging indicator, what is anticipated going forward based on past numbers, and this is referred to as a leading indicator, and what is happening right now, referred to as a coincident indicator. Economic indicators are designed to try and give a picture of the growth the economy is experiencing, the level of price increases or inflation that the economy is experiencing, or both. So you have, indicators that are designed just to give a picture of the growth in the economy, indicators that are designed just to give a picture of price increases in the economy, and then indicators which are designed to give a picture of both to varying degrees. One of the most important and therefore market-moving economic numbers after GDP is the non-farm payrolls number. This is released at 8:30 a.m. on the first Friday of each month. It's released by the Bureau of Labor Statistics, and it's a number that is meant to represent the number of jobs added or lost in the economy over the last month. And this is not including the farming industry, as the name implies. The farming industry is not included here because of its seasonal hiring tendencies, which would distort the number around harvest times, for example, as farms add workers for the harvest and then release them shortly thereafter. As with GDP, there's a huge amount of data published along with this report, all of which you can see on the Bureau of Labor Statistics website, and I've included a link to that site below this video if you're watching it on InformedTrades.com, or in the description section if you're watching it on YouTube. In general, increases in employment means businesses are hiring, which means they're growing, and also more people are employed, so people have money to spend on goods and services, fueling further growth. And the opposite is obviously true with decreases in employment. While the overall number of jobs added or lost in the economy is obviously an important current indicator of what the economic situation is, the report also includes several other pieces of data which can move the markets, okay? And these are the unemployment rate, okay, or what the unemployment rate is in the economy as a percentage of the overall workforce, okay? This is an important part of the report, as the amount of people out of work is a good indication of the overall health of the economy, as well as a trend in this. And this is a number that is watched by the Fed, as when it becomes too low, generally anything below 5%, inflation is expected to start to creep up as businesses have to pay up to hire good workers and increase prices as a result. Number two is what sectors the increases or decreases in jobs came from, and this can give traders a heads up on which sector of the economy may be primed for growth as companies in those sectors, gear up employment or gear up hiring in anticipation of future growth. The third is average hourly earnings, and this is an important component because if the same amount of people are employed but are earning more or less money for that for the same amount of work, then this has basically the same effect as if people had been added or subtracted from the labor force. Okay, and then number 4 is revisions from previous non-farm payrolls releases, and this can be a market moving component of the release if there are significant revisions on the past month's numbers as traders adjust their expectations for prices based on or on the markets based on that revision. As with all economic numbers that we study, after following the release for several months in a row, you're going to have a good feel of what the market is focused on and how it will most likely react should the number come in off estimates. With this in mind, I'm going to be posting a discussion piece on this lesson in the informedtrades.com blog section under the lesson in the comments section of this lesson. So if you're watching this video on YouTube.com, I've included a link to that lesson in the description section of the video, and I encourage everybody to check back there after the next non-farm payroll number, which is not this coming Friday, but the following Friday, and we'll get discussions going there on that. If you'd like an email notification when I start posting there, you can go to that thread and go to Article Tools after you've logged into the forum and subscribe there. Okay. That's our lesson for today, and tomorrow's lesson we're going to continue our discussion on economic numbers, so we hope to see you then. As always, if you have any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.